Hello, everyone. My name is Chris Huntsman. I'm Director of Internal Sales here at OneAmerica. Today, we're going to get into setting up that long-term care sale and conversation with clients. Then we'll jump into the different solutions we have here at OneAmerica. Now, you should be able to download a copy of the slides from the handout section of the GoToWebinar panel on your screen. But if you do have any kind of issues downloading it, just email me. You should have my email address from when you registered. It's just chris.huntsman@oneamerica.com. So once again, if you have any problems pulling a copy of the slides, just email me. I can shoot them over to you as well. All right, so before we get started for a moment in the sun here, and I'll assume you're all speed readers. All right, so to get started, I want to first kind of paint the picture together of what long-term care costs look like. Right now, the average cost of care nationally is about $100,375 per year, and that's for a private room in an LTC facility. Now, obviously, it's a little bit less in some parts of the U.S. and in some parts a little bit more, but I just want to kind of use this average now as just kind of an example that we're going to work off of. So now we know medical costs have gone up over the years, and typically it's somewhere in that 4 to 6% range. But for the sake of our example, I'm just going to assume a conservative flat 3.5% inflation rate for medical costs. And over the next 10 years, if I do that, a one-year stay in a private room grows to $141,589 per year. And if we extrapolate that out over 20 years, it's going to grow to just under $200,000 per year for that one-year stay in a private room in a long-term care facility. Now, obviously, there's several trends that are going to impact that cost of care going forward. And the first one is just higher demand. There's 10,000 baby boomers turning 7 years old every day. And most of the baby boomers are fine health-wise, so we don't really expect it to hit baby boomers for another 10 to 15 years. But when it does, simple supply and demand tells us the cost of care is going to go up because of it. Now, another issue is that by the year 2035, for the first time in U.S. history, older generations are actually projected to outnumber children, and that's according to U.S. Census data. So once again, that's by the year 2035. And that kind of raises the question of take care of this aging population. Then that second trend that's really going to impact it's going to be just longer lifespans. The medical community is making these huge strides in making us live longer, but unfortunately, there haven't really been any advances in preventing or curing, Alzheimer's or other forms of dementia. And those types of illnesses are going to require longer periods of care. We've even seen projections that millennials could have an average lifespan to age 110. So our bodies are living longer and longer, but our brains just can't keep up. Thus, we're going to continue to see the average long-term care claim go up both in the duration and in the cost. Then that third trend, and this is one I'm sure a lot of you have seen, is family dynamics. It used to be adult children would stay close to home, but now children leave home and move hours and sometimes states away. But with adult children living farther away, there's going to be less informal care being given by adult children and a much heavier reliance on formal caregiving being done by home health care agencies and long-term care facilities. So that kind of goes back to the higher demand. Then that fourth trend is going to be the government. And no matter how you feel about the government, we can actually all agree on one thing, and that's that it's always changing. And when we talk about the government and we talk about long-term care, we're really talking about Medicaid. Well, Medicaid, just like the government, is always changing, and no one can really say what its rules and qualifications will look like in 5 years, let alone 20 years from now. And right now, most states, their biggest expense is Medicaid. So just like you with your household budget, states are going to look at their biggest expense first as a way to cut costs. So what's going to be available and who's going to qualify for Medicaid 15 to 20 years from now really becomes a difficult thing to judge. And we've already seen look-back periods extended from 3 to 5 years. We've heard talks of extending it to 10 or more years. We've seen states like Minnesota creating think tanks on how to cut Medicaid long-term care spending. We've seen the addition of filial law for a lot of states. For those of you not familiar with filial law, I'll spell it for you. It's F-I-L-I-A-L. And while filial law does a lot of things, it has one thing it does for Medicaid that we all need to be made aware of. It actually allows the states to go after children for the cost of care that was provided to a parent by Medicaid. So all these things are just the beginnings of the states trying to cut down that expensive Medicaid. Because once again, that's their biggest crisis when it comes to their budget. That's their biggest spending. So now let's kind of take that average cost of care in 20 years that we projected out on our previous slide. And if you remember, it was just under $200,000 per year that we projected out with 3.5% inflation, projecting out 20 years. And let's see what that looks like over the average length of care. So the average length of care, according to Medicaid, is 2.2 years for men and 3.7 years for women. Now, keep in mind, that's just for care in a long-term care facility, and it doesn't really account for home health care because Medicaid typically doesn't pay for home health care. But we're just going to kind of use those numbers now just as an example that we're going to walk through. So if we use those numbers, that would make the average claim for men in 20 years $439,395, and for women, $738,982. Also, if we take the average Alzheimer's claim of 8 years, that would be a claim of just under $1.6 million. Now, obviously, all the numbers on the screen here are averages, but now ask yourself, well, how do we get to an average? So to kind of drive this point home, I'll kind of use the average NFL career length since we got the combine here in town in Indy. Well, the average NFL career would end with about 4 minutes to go in the fourth quarter, in the fourth game of the fourth season of a player's career. So now ask yourself, well, how many players does that actually happen to? And the answer is none. There's players that play 20 years in the NFL, and there's players that play one game in their entire career. And the same thing would really apply to the averages here on the screen. These will happen to almost no one. Some people will never have a single day of long-term care, and some are going to have 16 plus years of care. Matter of fact, we had a policyholder this year at One America go into her 16th year of claim with us. Now imagine if she had planned on the average with an LTC policy that only lasted 4 years. She would have spent the last 12 years exhausting her legacy, eating up the assets for her spouse's retirement income, and probably in a Medicaid bed, letting the government dictate the quality of care for her. So these are all just kind of examples of why we shouldn't plan for the average when it comes to insurance. And if you really think about it, the long-term care insurance industry is the only one where we see a lot of people planning for the average claim. In every other insurance industry, people solve for the catastrophic. So we protect ourselves from a total loss of our home in a fire, or for cancer treatments when it comes to medical insurance. So why is long-term care different? Well, if we're really honest with ourselves, it's really because we've allowed ourselves to kind of be brainwashed by all these LTC insurance carriers that we need to solve for the average because that's all most of them are willing to sell us policy-wise. So we've got to retrain our minds to protect our clients against that catastrophic risk because remember, that's why insurance companies exist. It's to remove that catastrophic risk off of the individual. So I mentioned here at One America, we had a client go into her 16th year of claim with us this year. And as you're going to be able to see on this slide, we're not alone with that. So based on a January 2019 American Association for Long-Term Care Insurance survey of the leading long-term care insurers, here's the longest claims that are still open at 7 top long-term care insurance companies. So just looking across the numbers quickly, you're going to see 14 years, 16 years, 19 years, 15 years, 9 years, 14 years, 11 years, and so on. And unfortunately, in that same survey, it was also determined that 13.5% of claims ended due to benefits being exhausted. So it goes to show solving for that average long-term care need can be absolutely devastating to families. Not everyone's going to be average, nor can we really guess who's going to be. Also, these numbers help illustrate even men can have catastrophic long-term care claims. If you look at most companies, men are currently the longest claim they have going. So this helps kind of illustrate longevity isn't just a female risk, because a lot of times we hear that out there that, well, if it's a male, we're not going to put, lifetime benefits around them because, men don't typically have long-term care claims. As you can see, that is very much not true. And in most cases, a male is the longest claim at most insurance companies. And the number one reason is because this right here. Right now, about 5.6 million Americans age 65 and over have Alzheimer's, which is about 1 in every 10 people age 65 and over, and more being diagnosed every 33 seconds. And we actually expect this number to more than double by the year 2050. Now, another stat now on this slide is that 1 out of every 3 people over age 65 dies with Alzheimer's or some other form of dementia. So I'll repeat that one since it's not on the slide. 1 out of every 3 people over age 65 dies with Alzheimer's or some other form of dementia. and that's according to the Alzheimer's Association. So all these numbers are just going to continue to escalate in the coming years as that baby boom generation continues to age past 65, because that's when their risk of developing Alzheimer's disease is at highest. So all this just kind of leads to the conclusion that we've got this perfect storm brewing in this country for a dramatic increase in long-term care costs and in the need. So obviously there's a lot of stats out there in the long-term care industry, and I apologize, I've already thrown a lot at all of you. But the most popular one, and the one I'm sure most of you have seen before, is that 70% of people over age 65 require at least some type of long-term care service during their lifetime. And then of that 70%, 20% will require long-term care for more than 5 years. So now if you'll kind of bear with me, using these numbers, I just want to kind of share you a quick story I was told by one of our wholesalers. And this wholesaler, she was meeting with an advisor who said he was kind of struggling with offering lifetime benefits. So I'm going to retell her story to me in her own words. And I'm going to begin that story from her point of view right now. So we're at this client event, and the clients began to fill the room. And I was just at the front of the room just preparing the equipment for the presentation, and the advisor walked up and said, can you kind of help me understand why someone's going to want lifetime benefits? Isn't it really only like 1% they're going to actually need it? And I responded, no, it's quite a bit more than that. Let's kind of use this group of people that are already in the room to kind of paint that picture with them. So there's 20 clients here today so far in the room, and we know that 20% are going to need care for longer than 5 years, and many are going to need care due to Alzheimer's, which has an average length of care of 8 years. That means 4 of these 20 clients in the room are going to need a lifetime benefit option. So go ahead and pick out which 4 are going to need the option. Well, obviously, the advisor smirked, though, knowing he's not going to be able to tell me which are going to need it. So I went further to explain, you see, if you helped all these people plan for the average, then you would have single-handedly ruined 4 families' lives. Everything they've worked to build, retirement for the surviving spouse, a legacy for their children, all potentially completely devastated along with their plan and family. Now, if all 20 planned for the lifetime option, you could know with almost certainty that all the planning is still going to be intact for however long they need care. Besides, if you polled every client in this room and asked them, well, do you want income for 3 years or the rest of your life? They're undoubtedly going to tell you, well, I want it for my life. And that was the end of her story. And I kind of like that story because it paints a good picture, in my opinion, of why we need to be solving for the catastrophic. I would never want one of my clients to feel the pain of their LTC plan falling short. So now here's the problem. A lot of clients will think they're in that 30% that don't need care, or won't need care, I should say. And you're going to hear all kinds of excuses from them as to why they're in that 30%. Unfortunately, nursing homes are full of people that made the exact same excuses. In reality, people just don't want to talk about it. They just want to deflect that conversation because it's not really a fun thing to kind of picture yourself in a situation where you can't take care of yourself. So now we have to ask ourselves, well, how do we get clients to talk through something they're uncomfortable talking about? Well, everything we've talked about up to this point is really talking about the risk of long-term care. So just throwing stats at people, that's really talking about the risk. Well, when you're sitting across the table from a husband and wife, typically if you're throwing those kind of stats and things like that out there, typically the wife's going to hear the stats and the risk and be ready to put a plan in place for LTC. But unfortunately, when a healthy male hears the stats and the risks, he's typically going to be the one that thinks he's in the other 30% that won't need it. Now, for the ladies on the webinar, please don't think it's because men are stubborn. We are, but that's not why we think that way. It's because men don't react to risk. Men always think it's going to happen to someone else because it's really innate for men to think they're always going to be around to provide and protect the ones they love. So to get through to healthy men in their 50s, 60s, and 70s, we've got to take it a step further and talk about the consequences. So now the question is, okay, great, well, how do I do that? Well, probably the easiest way is to just ask your clients 2 simple questions. First question is, you may never need care, but if you did, how will that affect your family? Now, too many people think they'll just have their spouse or their kids take care of them, but they never really think about how that would affect their family to be that caregiver. If you rely on your spouse, that usually leads to the spouse breaking down physically and emotionally because of that strain it puts on the caregiving spouse's body and mind. It also typically leads to the spouse needing care down the road because of all that. Now, if you rely on one of your children, there's additional issues you're going to create. How would you feel if your son or daughter had to quit his or her own job to take care of you? How would that affect their finances not being able to work? Would the caregiving child resent his or her siblings not really chipping in or giving care? Because we know care is typically going to fall on just one of the siblings to deal with. For example, my parents and I both live in Indiana. My brother lives in North Carolina. I can pretty much guarantee if I don't have an LTC plan in place for my parents, I'm going to be the one that takes care of them, not my brother. Will I start to resent him for not really helping out or being around to help? I'll be honest. Probably. At the end of the day, as a parent, you've always wanted your children to thrive on their own. But if you're not putting a plan in place for long-term care, you're really asking your children to put their lives on hold to take care of you. So all we're trying to do is we're trying to put a plan in place where we can have your children or loved ones be that care supervisor instead of a caregiver. And there's a huge difference between those two things. Kind of as an example, a care supervisor is attending their child's t-ball game. A caregiver is missing their child's t-ball game to be in the home of their parent taking care of him or her. So huge difference between, once again, being a care supervisor versus being a caregiver. So once we kind of got them on board with putting a plan in place, the second question we're going to ask is, if you did need care, how are you going to pay for it? And there's really three options a client typically is going to answer with. There's the government, which once again will be Medicaid. That's going to require they spend down all of their assets to get down to a minimal amount. And once they do, they can't really do home health care because typically Medicaid's only going to pay for a non-private room in an LTC facility, barring some kind of major exception. So I always like to tell clients, imagine spending your remaining years of life in a room with a roommate who's hard of hearing and likes to listen to a lot of radio extremely loud. It's not really a pleasant picture of how to spend your remaining years of life. Also, typically, most Medicaid facilities have about one nurse for every 16 patients versus a private payer insurance paid bed where it's about one nurse for every 4 patients. So the quality of care drops dramatically for a Medicaid paid bed. And then lastly, I don't know about you, I like to keep the government out of my life as much as possible. By planning for Medicaid, you're letting the government dictate what type of care you receive. So if you wanted to be in a long-term care facility that's, within 30 minutes of all your family, well, Medicaid may say, well, you're going to be 3 hours north in another city. Now, how often are you going to see your family? How often are they going to be willing to make that, 6 hours, 3 hours there and 3 hour drive back to come see you? Now, the second option a client might say for paying for long-term care is they may say traditional standalone long-term care insurance. Now, that option can be a good fit, but the problem is a lot of clients haven't bought it over the years because they didn't like that use it or lose it premiums, or the fact that premiums aren't fixed and they can have rate hikes. Also, a lot of carriers have left the traditional long-term care market, so it's really becoming difficult to find a traditional long-term care company that's willing to do more than a 2 to 4 year type of policy. And that's really more of a short-term care policy. And remember, we need to take that catastrophic risk off our clients. So we're not really doing it with a lot of the options that are out there with standalone traditional long-term care insurance. Now, the third option the client might answer with, and the one I'm sure most of you probably heard probably the most, is that they're going to self-fund it. So especially you hear this with your affluent or mass affluent clients. But even for the affluent or mass affluent clients, there's better options because I don't care how wealthy you are, you still have health insurance. And you do that because you wouldn't want to self-insure or self-fund that risk of getting cancer. You'd still want to put that catastrophic risk of paying for cancer treatments on an insurance company, even if you could afford it otherwise. I've yet to hear a person tell me when they're kind of looking into their health insurance carrier, please just cover smaller risks. I don't really want to cover cancer. Well, the same thing should really apply to long-term care. Affluent people can self-fund that 1 or 2 year type of need, but you wouldn't want to self-fund an Alzheimer's claim of almost $1.6 million like we projected out earlier. And remember, that was just an average Alzheimer's claim we projected out, let alone a catastrophic 16+ year type of need. Now, another thing to consider for our clients that plan on self-funding is how that affects their retirement. When you self-fund, you're obviously spending your assets for long-term care. Well, what clients and sometimes advisors tend to forget is that assets in retirement is what you're using to create your retirement income. So if you're spending your assets, you're lessening your retirement income, and at a time when your expenses are at their highest due to those long-term care costs. Now, while we compete against the misconception of solving for the average for long-term care protection, that's actually not our biggest competitor here at OneAmerica. The biggest competitor we have is affluent clients thinking they have enough funds to self-insure or self-fund that risk. So to kind of help paint that picture together, imagine a married couple with $2 million in assets that's driving their retirement income. Now imagine them having to spend $1.5 million for Alzheimer's care on one of them. Now they only have $500,000 left in assets to really drive their retirement income. So what does that mean to their income stream? Well, if they're doing a 4% withdrawal per year off of those assets to live off of, they just went from $80,000 per year in income to $20,000 per year. So their income just dropped 75% due to only having $500,000 left to provide that income stream. At the end of the day, they had the assets to cover that risk. But in reality, they couldn't afford to self-fund because now they've blown up their retirement income. So long-term care, it's not really an asset issue, it's an income issue. Self-funding doesn't prevent that. The number one thing that can absolutely blow up a retirement plan is a catastrophic long-term care event. We've got to take that risk off the table for clients. And the only way to do it is with a lifetime benefit option. The same issue could arise if the clients had an LTC plan that only covered 4 to 6 years and fell short. So now that we've kind of set up the long-term care conversation with clients, I want to talk about what we do here at OneAmerica to kind of mitigate that risk and consequences of long-term care. So basically, it's shameless plug time. So to kind of talk about what we do here at OneAmerica, I want to walk through an example. Husband and wife. He's 61 years old. She's 60 years old. And here on the screen, we've just got kind of a generic portfolio with an asset allocation for this couple. They've got some aggressive funds, some moderate funds, and some conservative funds. If I ask them that second question of, well, what's the asset you would spend down first for long-term care? They're likely to point to something in that conservative bucket because those funds are typically the most liquid for clients and typically have the least growth potential. So let's say this couple points to $125,000 sitting in a CD at the bank. First off, I'm going to tell them, it's great that you've got this money earmarked for long-term care, but let me show you a better way to allocate it for that exact use. Now, when it comes to allocating assets, affluent or mass affluent clients, they look for two things. They look for tax advantages and leveraging. And when I say leveraging, I mean, well, how do I turn my pennies into dollars? So we're going to actually show them how to do those two things with this asset for long-term care. Now, before we get into how we create the tax advantages and the leveraging with this asset for long-term care, I want to first talk about kind of our thought process when we were looking at creating a long-term care solution back in 1988. So in 1988, we decided to build a product around a whole life policy chassis because we knew it would overcome the two major objections with traditional long-term care insurance. One, people didn't like the fact with traditional long-term care, their premiums were use it or lose it, meaning if they didn't have an LTC claim, they'd get nothing from the policy. And two, they didn't like the fact that with traditional long-term care that premiums weren't fixed and they could get those rate hikes. Well, with a whole life policy, we can make everything ironclad guaranteed, including the premiums and the benefits, and we guarantee the client gets something out of it regardless if they ever have an LTC claim. So with these clients, we're going to simply reallocate their $125,000 CD into our whole life policy called Asset Care. So basically move it from their left pocket to their right pocket, but still keep it as an asset in their portfolio and on their balance sheet. Now, since we're using a whole life policy, we'll have a cash value in the policy that's guaranteed to grow over time, and we're going to create a death benefit. For this couple, it would generate about $250,000 second to die death benefit. So if they never have an LTC claim, we've created a $250,000 benefit for their kids, grandkids, or some other third party. So this starts to help overcome that objection of use it or lose it that we see with clients on traditional long-term care because everyone dies. Whether you have an LTC claim or not, you're guaranteed to die, so you're always guaranteed to get something out of this policy. Now, if either one of these clients does need long-term care, we can simply accelerate the life policy's death benefit tax-free for their long-term care needs. So we call this acceleration of benefits for the LTC the AOB rider. So AOB just stands for acceleration of benefits because we're simply accelerating out that death benefit for long-term care. So what we've done is we've taken $125,000 that they had earmarked for long-term care, and we've turned it into $250,000 tax-free bucket for long-term care. There's that leveraging and tax advantages of what people are looking for when they're kind of looking, where do I reallocate assets? Now, if either one of them needs long-term care, basically what they're going to be doing is they're going to be paying 50 cents on the dollar. So it's kind of like we put long-term care on sale for them. Now, the best part of the product is not the life policy being accelerated for long-term care. The best part is this optional rider that we can tack on the back end of the life policy called a continuation of benefits, or COB rider. And we can actually add on the COB rider for a lifetime long-term care benefit for the clients. So now we're taking that catastrophic risk of a long-term care claim off of the clients. And remember, once again, that's what insurance is meant to do. The best part about it is we've set this up as a high deductible, catastrophic long-term care plan for the clients. And high deductible catastrophic insurance, that's what affluent people want and buy. So kind of think about other types of insurance affluent people buy, like medical insurance. While the average person on the street might have a $500, $1,500, or $2,500 deductible for medical insurance, affluent people prefer things like $3,500, $5,000, or $10,000 deductibles for their medical insurance. And the reason is they can easily afford to cover a small medical event like a minor ER visit, but they wouldn't want to cover the cost of cancer treatments themselves. So by taking on more of the smaller risks themselves, they can get their catastrophic insurance at a much more affordable rate. We've just taken this high deductible catastrophic way of purchasing insurance and we've tied it to long-term care. Because you spend down the life policy first, which in this case is the $250,000, it's acting like a deductible to that lifetime benefit COB rider, which is your catastrophic risk coverage. So kind of think of your life policy, it's kind of like your health savings account that you're spending down first to meet your deductible before your COB rider kicks in for your catastrophic long-term care insurance coverage. So what this does is it all allows us to offer the COB rider or your catastrophic LTC insurance coverage at about 50 to 70% more affordable than a standalone traditional long-term care policy would be. So while I'm throwing a lot at you today, the number one thing I want you to take away is that One America is a high deductible, catastrophic long-term care insurance policy. Now, at this point with a client, there's one other thing I like to tell them because it's something that no other long-term care company can say. At One America, we cover the extremes. So we cover the extreme of a 16-plus year claim with the lifetime benefit rider, and we cover the extreme of no days of long-term care because we pay out the life insurance death benefit. And oh, by the way, we cover everything in between. So once again, at One America, we cover the extremes and everything in between. No other insurance company can make that claim with long-term care insurance. So as I mentioned, Asset Care is our solution where we use a life policy as a deductible and then have that optional COB rider that covers the catastrophic long-term care risk. But with Asset Care, we've got 4 different funding methods because we wanted to make sure we had a solution for whatever asset a client points to when you ask them that question of, what's that first asset you would spend down for long-term care? So all 4 funding options that you can see on the screen here, they can be with or without a COB rider. They can be set up as a single insured or joint insureds. Joint insureds do have to be people that are spouses in a civil union or a domestic partnership. Now the funding options, I'll kind of walk through them real quickly here for you. There's a single premium option, which is for lump sums coming from like cash equivalents, CDs, money markets, and like-to-like life policy 1035 exchanges. There's single premium with return of premium, which would be for the same funding methods, but now we're going to add on an ROP feature. Then there's annuity funding whole life. And annuity funding whole life, which we'll get into a little bit more later because there's some moving parts to that one. This one would be for lump sums coming from a non-qualified annuity or qualified funds like 401ks, 403bs, traditional IRAs, etc. So basically an asset that we couldn't move directly into a life policy. And then we also have a recurring premium option for people that maybe don't have a lump sum that's liquid, but maybe they have a good income stream they can use to fund it. Now the recurring premium options are a 5-pay, 10-pay, 20-pay, and a paid age 95. Now these recurring premium options, they can be done on a monthly, quarterly, or semi-annual basis as well. Now if the client does have, let's say they've got an old variable annuity with an income rider, or maybe they've got an old Allianz two-tiered annuity with a large annuitization value, you can also get a little creative from a sales idea perspective with the current recurring premium option. So let's say the client has a $100,000 cash value, variable annuity, but maybe if they annuitize or turn on their income rider, maybe that $100,000 is worth $200,000. Well, if you never annuitize or turn on that income rider, you're really throwing away all that potential leveraging that variable annuity was built for. The problem is, most clients don't want to give up the cash value for an income stream they don't need. But what we could do is, we could actually turn on the income rider or annuitize it for a 10-year period certain, and have that 10-year income stream fund a 10-pay asset care policy. Now, you would be giving up the cash value of the annuity, but you'll be recapturing the cash value in the life policy of asset care, all while gaining the leveraging from the old annuity and from the asset care policy. So it's really kind of a way to double down on your leveraging opportunity if you run into those kind of situations where the annuitization or income rider value of an old annuity is worth way more than the cash value. So now I want to kind of go back to our conversation with that couple where it was a 61-year-old male, 60-year-old female. I want to kind of show them a nice visual of how their asset care policy would work from an LTC claim standpoint. So I like to use a timeline example. So here on the screen is just a timeline where day one of paying out for long-term care would be on the very far left of your screen. Now we'd exhaust that life policy first before the lifetime rider kicks in. So if you remember our example, we used $125,000 from their CD to fund the life policy. That created a $250,000 long-term care benefit pool with the life policy. Well, if I did a standard 50-month spend down or 2% acceleration of the death benefit for long-term care, that would create a $5,000 per month benefit for each insured, or if you like to think of it from an annual income stream, that would generate a $60,000 per year income stream for long-term care per person. Now, after they've exhausted the LTC pool of the $250,000 from the life policy, they've now met their deductible, and the lifetime benefit rider is going to continue that $5,000 per person per month benefit for as long as either should need long-term care. Now, keep in mind, the monthly benefit is per person. So if they were both on claim at the same time, they could each pull out $5,000 per month for a total of $10,000 of LTC income in 1 month. Now, you can add inflation to the COB rider. Typically, we see about 3% compound inflation for 20 years of growth added on to the COB rider if the clients add inflation on. Now, if you do that, the COB rider's monthly benefit would start out growing from that $5,000 from day one that you own it, and it wouldn't stop growing for 20 years. You just can't access that growing LTC benefit pool of the COB rider until you've exhausted the life policy for long-term care. So it's really two separate pools of money: the base life policy and the lifetime COB rider. Now, I'm sure you're all thinking at this point, well, this is all fine and dandy, but what the heck does the rider cost? So to cover these two insureds, him at age 61, her at age 60, for an infinite pool of long-term care they can never outlive, starting at $5,000 per month per person with 3% compound inflation for 20 years of growth, it would cost them a combined $334 per month. And that's a fixed premium that can never go up in price. So for about the same premium they're probably paying for their combined cell phone bills and internet bill, we're giving them an infinite pool for long-term care they can never, ever outlive. That's pretty insane leveraging. And the reason we can offer that and at a fixed rate goes back to the high deductible catastrophic insurance concept. It's good for the client because they can get their catastrophic insurance coverage at a much more affordable rate. But it's also good for the insurance company because we know a lot of people won't get into the rider. A lot of people will pass away during the spend down of the life policy. So it's good for the company, it's good for the individual. Now, I do want to point out that if you bought the same benefits, because sometimes people will, well, I don't really have something to compare that to, that $334 a month. So as an example, there's one other insurance company in the long-term care market that does have a lifetime benefit option, but they are a traditional long-term care policy. So if I bought the same benefits from them as I get with the rider for us, it would cost about $6,000 to $8,000 per year, and it would not be a fixed premium. So that kind of shows you the huge advantage of doing the high deductible type setup and why we do what we do. So we're shaving off about 50 to 70% of that cost by doing the high deductible setup. Now the key is to make sure the client understands the $125,000 was just an asset reallocation and not a premium. The reason we can call the $125,000 just an asset reallocation is because it has a cash value and it's leveraged to $250,000 for death or long-term care. The only true premium is the $334 per month they're paying for the lifetime benefit rider. Another nice feature is that we will waive the COB rider premium while either insured is on long-term care claim on that base policy or the COB rider. And because we break out the LTC premiums from the life policy, the clients can use health savings account dollars each year to pay for the COB rider premium or potentially get a tax deduction for it as a medical expense. So if these were my clients, I might have them, pulling $334 a month out of their HSA to pay for the rider. Now, if you like to avoid ongoing premiums, so maybe you just don't want to have that recurring premium hitting the client for that lifetime benefit rider, you can choose to pay a single premium for the rider. In this case, instead of paying $334 a year, $334 a month, in this case, it would be about an additional $74,000 one lump sum to pay it up all at once. So if you kind of think about it in that sense, you'd put $125,000 towards the base policy, $74,000 towards the lifetime benefit rider for a total commitment of just under $200,000, and you'd get all of that back guaranteed from the $250,000 life policy you've created as either an LTC benefit or as a death benefit or a combination of the two. Now, me personally, I'd much rather do an annual or monthly pay lifetime benefit rider for a couple reasons. One, the rider premium does not generate any additional cash value or death benefit, so why pay it up all at once? So I'd much rather give an insurance company $334 a month than $74,000 all at once if I'm not going to get any additional cash value or death benefit from it. I'd rather keep the $74,000 somewhere else generating income and then use just a $334 that I spin off of that income it's maybe generating to pay for the rider, or once again pulling that $334 from like an HSA. Now, another reason is that the rider premium is waived once again while any insured is on LTC claim. So I think it makes more financial sense to do a recurring pay lifetime benefit rider, but we still see a ton of the single pay rider because sometimes people just want the convenience of paying it off all at once. The good news is we can set up however your client, if they'd rather go the convenience route or if they'd rather go the route that probably makes a little more financial sense, we can set it up either way. Now, as I mentioned earlier, the standard spend down of the life policy for long-term care is 50 months. Well, at time of application, you could choose to shorten the spend down to 33 months on a joint policy. On our previous example, that 50-month base caused a $5,000 per month benefit. Well, if we shorten that down to 33 months, it would have been a $7,500 per month benefit. Now, no matter which base policy you choose, you can still do a lifetime benefit rider. You can also do a rider that mirrors the base policy. Now, if you're wondering, well, why wouldn't I always just do a 33-month base over a 50-month base to get the bigger monthly benefit? It's because of the COB rider. The more you shorten your base policy or shrink your deductible, if you will, the more you're going to increase your COB rider premium. So it's kind of a trade-off. So what we see a lot of people do is we see a lot of people use the 50-month base if they want to do an annual pay COB rider and have inflation protection on the rider. And we see a lot of people do a 33-month base policy if they want to single pay the COB rider or if they want to have inflation on the, or if they don't want to have inflation on the rider. So a lot of different ways we can set up, and I'll kind of show you an example, our previous example as a 33-month base a little bit later. Now, if you use a single insured policy, you will see one additional option for the base policy duration. You'll have the ability to do a 25-month base policy and increase the monthly benefit even more if you have just a single insured on the policy. Now, if you do a 25-month base for a single insured, you're also going to notice one additional COB rider option. You'll be able to do the lifetime option and the option that mirrors the base policy like with the other options, but you'll also be able to add on a 50-month rider on that 25-month base. So the good news is when it comes to case design, we've got a lot of options. The bad news is we got a lot of options. So when you're ready to do some case design on a client, don't get too hung up on all these different options we have. All you really need to know before you call your internal wholesaler or your marketer to do some case design is three things. One, you're going to want to know what's the client's current age. 2, just kind of a general health picture for the client. And then 3, what's the funding source or income stream the client would likely use to fund the policy? So once again, the 3 things: client's current age, a general health picture of the client, and then what the funding source or income stream the client would likely use to fund the policy would be. Now, here's an example of how we might tweak our previous case with that couple where it was the 61-year-old male and 60-year-old female, using the 33-month base policy that I mentioned on the previous slide. So let's say I solve for that $250,000 death benefit again. The base policy asset allocation would now be $133,000 instead of $125,000. That's because we're accelerating that same death benefit out faster at 33 months instead of 50 months. So there's a slight upcharge for that. Now, instead of $5,000 per month per person for LTC coverage, now we've got $7,500 per month per person, which, once again, if you like to think of it as an annual income stream, would be $90,000 per person per year. And now, because we've started out with a higher monthly benefit from day one, maybe we decide to take inflation protection off of the rider. Now, if we did that, we'd now have that $7,500 per month benefit per person for an infinite LTC pool. So it's going to stay flat the entire time of the claim at $7,500 per month. Now the cost for the lifetime rider would be $417 per month at a fixed premium, assuming you decide to go with the recurring premium option. So this just kind of shows how we can change things around a little bit and take a different approach to how we solve for the LTC benefits on asset care. So now I want to take a moment and dive a little bit deeper on the annuity funding whole life option, because this is a huge opportunity. Baby boomers were that first generation to invest heavily into qualified accounts, and now you're seeing a lot of them reach their 60s and 70s with a huge amount of qualified dollars. You're even seeing some of them that might be considered qualified rich but cash poor. Well, with this option, it can be funded with qualified or non-qualified lump sums. Now, real quick caveat here, non-qualified lump sums for this option would be coming from an outside non-qualified annuity or a life insurance policy 1035 exchange that's going from a single insured to a joint insured policy. Now, kind of getting back on topic with the qualified contracts could be funded from any account basically that can move to a traditional IRA. So 401ks, 403bs, traditional IRAs, SEP IRAs, simple IRAs, etc. Now, what we're going to do is the outside money is going to be moved tax-free to a single premium deferred annuity here at OneAmerica. That deferred annuity will have an income rider automatically included free of charge that's going to start paying out immediately. That income rider will be a 10-year certain income stream and also provide a 20% bonus to the funds transferred in. So for example, if you transfer over $100,000 of qualified funds, you'd get a total income stream payout of $120,000 due to that 20% bonus. Now, the income rider will be used internally to fund a 10-pay whole life policy, and the income stream would also fund a 10-pay COB rider, assuming you add the COB rider onto the contract. Now, one important note, you will not be able to pay the COB rider separately. It has to be funded from the income stream. So at the end of the day, the tax-deferred funds this client wants to use for long-term care is basically a tax bomb just waiting to go off. So the whole idea with this funding option is to spread out the tax hit of cashing out that old tax-deferred contract over 10 years instead of all at once. So an analogy I like to use with clients is just thinking of a bottle of soda or pop or Coke, depending on where you grew up. Now, if you had a bottle of soda, and let's say I'm a big jerk, and I shook it up and gave it back to you, what would you do if you wanted to take a drink right away besides maybe punch me? Well, you wouldn't just rip the cap off because the soda would spray everywhere. Instead, you'd slowly twist that cap over a short amount of time to slowly relieve that pressure before you took a drink. That's what we're doing here. We're slowly relieving the pressure of taxing that tax-deferred asset over 10 years instead of 1 year. So the tax hit is less eventful and noticeable to the client. Now, lastly, all long-term care benefits are paid from the life policy and the lifetime benefit rider that you might attach on. No LTC benefits are paid for option. And that's a good thing because that means all LTC benefits paid out are going to be tax-free regardless of when you start claim. Now, if you're looking for leads, I would recommend learning this option inside and out and then showing it to estate attorneys in your area. Estate attorneys hate IRAs, and they hate them because they can't put them in trusts. And they love second to die life policies because they use those to help offset the taxes of the estate at the second death of two spouses. Well, with the annuity funding whole life option, we're not only giving their clients a second to die life policy, but we're also systematically lowering the taxable assets in the estate to do it while killing off the IRA. And oh, by the way, we're also protecting the entire estate from a catastrophic LTC event with the lifetime benefit rider. So if you think about it, we've lowered the taxation of the estate, we've leveraged dollars to pay taxes on the estate, and we've protected the entire estate from a catastrophic LTC event. That's a pretty powerful estate planning tool you won't find anywhere else. Now with clients, obviously we always like to use visuals. So at this point, I do want to give you a visual of how that annuity funding whole life option works. Once again, since there's a lot of moving parts with this. So for this example, let's say the clients have $200,000 sitting in the wife's IRA. We would transfer those funds over to an IRA here at OneAmerica. We would add in that 20% bonus, or $40,000 in this case, thus raising their income rider value to $240,000. Then we're going to start the income payments over 10 years, which in this case would result in $24,000 per year of income payments. The owner would get a 1099 for the income payments each year. Now, as the income payments occur, you're going to see the value of the annuity drop until there's nothing left in the annuity after 10 years. Now, here's an example of what that might look like from a benefit standpoint for the same couple. So their $200,000 turned into a tax-free death benefit of $235,000 and an infinite long-term care pool the clients can never, ever outlive, with a monthly tax-free income stream of $7,050 per person, or once again, if you like to think of it as an annual income stream, $84,600 of tax-free income per person per year if they ever needed long-term care. So huge opportunity here for these clients. So Asset Care is our whole life-based approach for long-term care that we started back in 1988. Well, in 1998, we wanted to expand our Care Solutions portfolio to include some annuity-based options. And this would really allow us to create a long-term care leveraging for clients who maybe couldn't qualify or might be highly table rated for our life-based approach due to being too much of a mortality risk. We call these annuity-based LTC policies annuity care. And these products follow the same concept of a high deductible catastrophic long-term care policy, but now you spend down an annuity first as your deductible instead of a life policy. Then the COB rider kicks in for the catastrophic coverage. Now you're going to see that we have three options for annuity care, and we'll kind of go through each option a little bit later. But the first thing I want to do is I want to touch on something that happened in 2010 and really made the annuity care solutions really exciting, kind of jump off the page at people. So in 2010, the Pension Protection Act went into effect. And while the Pension Protection Act, or PPA as a lot of people refer to it, while it did a lot of things, it did one specific thing that applied to long-term care. It allowed for non-qualified annuities that are filed with an outline of coverage for long-term care to be used tax-free for long-term care expenses. Where this became huge is with people in that 70 to 85-year-old age range. A lot of people in that 70 to 85-year-old age range, a lot of them have these large non-qualified annuities with a lot of gains built up in them. A great idea is to look at your book of business for clients in that age range with non-qualified annuities and just call them up. What you're going to do is you're going to ask them, okay, what is this money earmarked for? I can almost guarantee you they're going to say the word emergency. Now, the reason they'll say that is because at that age, their retirement income is probably well in place. So they don't really want to annuitize the annuity and give up the cash or the asset, if you will, for an income stream they don't need. They also don't want to cash out the annuity because of all the taxes they would owe on the gains. So these large funds end up just becoming a quote-unquote emergency fund. So now just ask your client to tell you what might constitute an emergency where they tap into those funds. They're highly likely to start describing a long-term care event. So then it's as simple as saying, well, great, let me show you a way you can use it for that exact purpose that you've got it earmarked for, tax-free. I don't know many clients that would say no to meeting you for that. So as an example, kind of imagine a 78-year-old female with $150,000 sitting in an old non-qualified annuity that's earmarked for that quote-unquote emergency. Let's say she has a $50,000 cost basis and she's accrued $100,000 of gains over the years. Well, if she pulls the funds out for long-term care, it's not really worth $150,000 because she's going to have to pay taxes on the gains as she pulls it out. So it might really be worth somewhere around $100,000 to $125,000 depending on her tax bracket. But she could 1035 exchange it into a One America PPA compliant annuity and potentially add on her spouse if she wanted to. Now when she pulls the funds out for long-term care, they're going to come out tax-free, so her annuity is really worth $150,000 to her. And once again, you can't do this with any old annuity. You can only do this with a PPA compliant annuity that has an outline of coverage for long-term care. Now, as I mentioned, Annuity Care first came out in 1998. Well, we did refile it to be PPA compliant in 2010. So non-qualified contracts are tax-free for LTC use. You would just spend down the base annuity first over 36 months for LTC. The base annuity is a fixed single premium deferred annuity. Once you exhaust that annuity, the optional COB rider you choose then kicks in to continue those long-term care benefits, just like we did with that. So the COB rider is optional, and it can be funded with a recurring premium or a lump sum premium, also similar to asset care. So once again, the annuity acts like your deductible and your health savings account that you spend down first before your catastrophic insurance coverage kicks in. So now I'd kind of like to walk you through a typical case design we see with Annuity Care. So let's say we've got this 78-year-old female. Once again, remember she had that $150,000 just sitting in a non-qualified annuity with a lot of gains built up that she didn't need for income. We could just 1035 exchange it to the base annuity and call it a day. Then she'd have access to her $150,000 tax-free for long-term care use. Now, if she really wanted to create a ton of leveraging, she could split the 1035 exchange to fund both the base policy and a single pay lifetime benefit rider. If we did that, you'd end up with something like $124,300 going into the base annuity, and then the remaining $25,700 remaining moving over to the tax-free bucket for the lifetime benefit rider. So now she's taken a taxable finite amount of money and turned it into a tax-free infinite pool of money she can never outlive for long-term care. And if you like to think of it as an income stream, you're creating a long-term care income stream of $43,200 per year that's tax-free for the rest of her life for the exact emergency she had that money earmarked for. So that's fantastic leveraging, especially at the age of 78. Now, if she never needed long-term care, the $124,300 we left in the annuity plus the interest it earns would bypass probate and go to their named beneficiary. Now, when we knew the PPA or pay effect, we knew we could refile Annuity Care to be PPA compliant and tax-free for LTC use with non-qualified funds. But we also knew we could create a second Annuity Care option that took even more advantage of the PPA. So in 2010, we released Annuity Care 2. Now, where Annuity Care 2 differs and takes more advantage of the PPA is that the COB rider is no longer optional. It is automatically included, and it's funded by us taking a small monthly BIP charge from the base annuity to pay for one of 3 COB riders you see on the screen here. Now, because the annuity is PPA compliant, that small charge we take each month from the annuity to pay for the COB rider comes out tax-free. Now, with Annuity Care 2, what you're going to do is you're going to spend down your base annuity first over the course of 24 months for a single insured or 30 months if it's a joint insured policy. Then you'll choose whether to have a 36-month rider, 72-month rider, or 108-month rider kick in to cover the extended long-term care need. Now, you will notice there's no lifetime benefit option on Annuity Care 2. That's because we wanted to keep the internal cost coming out of the annuity a little bit lower. Now, from a leveraging standpoint, with these 3 rider options, you're basically choosing whether you want your COB rider base annuity funds by either 2.5 times, 4 times, or 5.5 times. So an example, if you put $100,000 in the base annuity, the rider options you're choosing to either leverage your money to $250,000, $400,000, or $550,000 tax-free for LTC use from your $100,000. Now you may be wondering, well, why wouldn't I always just do the biggest COB rider to get the biggest leveraging play? And there's a couple reasons you might choose a smaller COB rider. One, they are age-based. You can get the 36-month rider through age 80, the 72-month rider through age 75, and the 108-month rider through age 70. Also, the bigger the COB rider you choose, the more hit you're going to take to your cash value of your annuity. So if the cash value of the annuity matters to the client, you'll probably do the 36-month rider. If the cash value doesn't matter and it's all about creating the best LTC benefit you can, you'll probably do either the 72 or 108-month rider and then add inflation onto the rider. Now, over the years, we've had people tell us, hey, I love the concept of annuity care and annuity care too, but I'd really like more potential cash value growth than the fixed annuity can provide on those products. So in 2014, we introduced indexed annuity care. Still the same concept of spending down annuity first for long-term care, but now we're using an indexed annuity to get more potential cash value growth on the annuity instead of a fixed annuity. Now the COB rider is going to be optional again, and the COB rider options would be to either double your annuity value, triple it, or create an infinite pool for long-term care with the lifetime option. Now with this option, you would pay for the COB rider either as a recurring premium or single pay, just like we did with the Asset Care and Annuity Care 1. And you can do the base annuity by itself as well. If you just want an index annuity that has tax-free withdrawals for LTC use, just throw some money in the base annuity and don't choose a rider option. Now, when it comes to indexing for cash value growth, we did want to keep it fairly simple. So we have just 4 indexing options. They're all tied to the S&P 500, and there's a fixed account option. The indexing options are a point-to-point with a cap, a point-to-point with a participation rate, a monthly average with a cap, or a monthly average with a participation rate. Now the client can mix and match the indexing options as he or she sees fit, and they can reallocate the percentages every year. So first year you might decide to have 100% in one of the indexing options, and then next year you might decide to put 25% in all 4 of the indexing options. Now one advantage that comes along with the higher potential cash value growth on the index annuity is that we guarantee the cash value can never lose money in down years of the S&P 500. Another advantage of the index annuity is that while you could see 0 cash value growth in a down year for the S&P 500, we'll always guarantee you get growth each year for the LTC value of the annuity. The base annuity actually has a guaranteed LTC growth step up each year, whether the cash value grows or not. So today we kind of touched on asset care and annuity care, but I do want to give a brief mention to legacy care before I let everyone go. Legacy care is just a single premium fixed deferred annuity with no real LTC benefits to it. But where legacy care might come in handy is if you have a client or a client's family that comes to you and says, hey, we got a letter from mom's annuity company that because she's hit age 90 or because she's hit age 95, they're forcing her to either annuitize that annuity or cash it out. Well, at age 90 plus, it's highly likely they don't want to cash the annuity out because they don't want to take the tax hit. It's also highly likely they don't want to annuitize it, so give up the cash value for an income stream they don't need, and not to sound morbid, but also probably wouldn't get for very long. So they're kind of stuck between 2 decisions they don't want to make. So the advantage for legacy care is that it issues through age 99, and we never force annuitization or cash out. So you could simply 1035 that old maturing annuity into legacy care just to continue tax deferral until death. So while I don't expect you to have a bunch of 90-year-olds beating down your door with this problem, just know that when you do, think of One America and we've got a solution for you. Well, that's it for today's webinar. I want to thank everyone for attending. Hopefully you all got something out of it. Also, remember the number one thing that I want you to take away is that asset care and annuity care, they are high deductible, catastrophic long-term care insurance policies. If you have any questions, please feel free to reach out to your internal wholesaler or your marketer. Also, if you have problems getting a copy of the slides off the webinar, once again, you can feel free to email me. I can email a copy of those to you. Thanks everyone for attending and have a great weekend.